Well, recording is in process, and now I suggest we can start. So, first of all, let me announce the title of the lecture for today, topic 3, and And the title of this topic 3 is Operating Decisions and the Accounting System. So here today we have five learning objectives. And first of all, we should understand the time period assumption or time period concept. What does it mean, business operating cycle? And what is the relationships between business operating cycle and time period assumption in accounting? Also, we should explain how business activities affect the elements of the income statement. So today we have income statement in our special attention. And I would like to comment the third learning objective as the most important, not only for today's topic, but also for the whole course, to understand the idea of accrual basis of accounting and what does it mean, the revenue and expense recognition principle to measure the income. So, dear students, this is the main learning objective of the whole course, not only for this topic. But as you understand, today's material is really important in accounting theory. Also, we apply transaction analysis to make records about operating activities on financial statements, and we just discuss what does it mean income statement, what does it mean classifications in income statement, and how to prepare classified income statement. So once again, today we have 5 learning objectives. And the main questions, general managerial questions in concern with today's topic is the following. How do business activities affect the income statement? How are these activities recognized and measured? And the third one, how these activities reported on the income statement. So first, the nature of business activities, recognition and measurement, and disclosure. 3 main components of accounting process: recognition, measurement, and reporting or disclosing this information in financial statements. So right now, let me switch to the videos. But before we start, I suggest to watch some videos from the previous material in order to refresh the main basic accounting principles and some issues concerning the language of accounting, I mean debits and credits. So let me again open. So what I suggest to repeat once again, yesterday I noticed that you did not catch properly the idea of some recognition and management concepts. So I suggest to remind this material.
Before we look at the definitions of the various items that appear on the balance sheet, we should learn about the 3 assumptions and the measurement concept. States that each business's activities must be accounted for separately from the activities of its owners, all other persons, and other entities. This means, for example, that when an owner purchases property for personal use, the property is not an asset of the business. The going concern assumption states that unless there is evidence to the contrary, we assume that the business will continue operating into the foreseeable future, long enough to meet its contractual commitments and plans. Under the monetary unit assumption, each business entity accounts for and reports its financial results primarily in terms of the national monetary unit, for example, dollars in the United States, without any adjustment for changes in purchasing power, for example, inflation. Finally, accountants measure the elements of the balance sheet using what is called a mixed attribute measurement model. Most balance sheet elements are recorded at their cost, or historical cost, which is the cash equivalent value on the date of the transaction. For example, assets are initially recorded on the exchange date at the cash paid, plus the dollar value of all non-cash considerations, such as the trade-in value of a used asset.
So, dear students, several important assumptions or principles, and the first one is about the separate unit approach. It means that business activities are not the same as the private activities of the owners. The second one, going concern. It means that we should measure we should measure business progress in terms of accounting periods. So we should divide into quarters or years in order to observe the financial results. Then one principle about measurement. So we should measure everything in accounting in order to make records by currency, national currency, or functional currency. But anyway, the measurement is the required, is the important procedure in accounting process at all. And mixed attribute measurement model we discuss in the further topics about cost approaches and cost rules recognition for every particular element. So right now I don't want to comment too much about this principle, but you should understand that mixed attribute measurement model, we should combine different elements or different components of the total cost of any asset. So this is about basic principles, and I would like to say that it's not the whole list. And today we discuss the most important accrual principle or accrual assumption of the accounting also. Now I would like to remind the structure of accounts and what does it mean, transaction analysis, and a few words about debits and credits, because in today's topic we also continue this transaction analysis.
Companies keep track of individual asset, liability, stockholders' equity, revenue, and expense items using a standardized format called an account. An account accumulates the dollar effect of transactions of a given financial statement item. Knowing the amount of total assets owned by a company is important, but management must keep track of individual assets. For example, most companies set up separate accounts for cash to make sure enough is on hand to pay bills, accounts receivable to keep track of what is owed by customers, and supplies to know when to reorder. As the company grows and acquires additional assets, additional accounts are set up for those assets. To facilitate the recording of transactions, each company establishes a chart of accounts, a list of all account titles and their unique numbers. The accounts are usually organized by financial statement element, with asset accounts listed first, followed by liability, stockholders' equity, revenue, and expense accounts, in that order. The balances of the accounts are then used to prepare the financial statements. The accounts you see in the financial statements of most large corporations are actually summations or aggregations of a number of specific accounts in their record-keeping system. For example, a company that operates restaurants would maintain separate accounts for food, beverage, and packaging supplies, but would combine them under supplies on its balance sheet.
So, dear students, please consider the piece of information, the portion of information concerning the particular item to be to be collected and to put records in the specific place, and we call this place as an account, So of course we understand that technically we should understand that these information should be aggregated in order to prepare balance sheet. For example, we can have the separate account for food, beverage, and packaging. Here we have this example, but in order to prepare balance sheet, we should aggregate into one item as supplies. But it could be the case that instead of some details, you can open one account as supplies and collect information about all supplies in one account. It depends how detailed information is necessary for you to make decisions. Of course, in the restaurant, it's absolutely impossible to collect information directly in supplies because you will never know about actual balances of beverage or packaging or other items, and it's better to open different accounts in detail to support the management process. But anyway, I would like to say that this decision is always the responsibility of the company to decide in what detailed level you require information collection, and depends on this approach, you can develop your own chart of accounts. So every company has its own chart of accounts, but based on these general rules. Normally, each chart of accounts contains 5 basic parts in accordance with the basic elements: assets, liabilities, owner's equity, including revenues and expenses. And based on this approach, we should provide transaction analysis. Let's see one more.
Transaction analysis is the process of studying a transaction to determine its economic effect on the entity in terms of the accounting equation. Recall that most transactions involve external events in which the business exchanges assets or services for assets, services, or promises to pay with one or more external parties to the business. In other words, each transaction involves an exchange. Something is received and something is given. As a result, every transaction has an effect on at least 2 accounts, one or more accounts relating to what is received and one or more accounts relating to what is given in exchange. This is known as the dual effects concept. The accounting equation must always remain in balance when we record a transaction. These 2 rules form the basis of the 2-step approach that can be used when analyzing transactions. First, consider what was received and what was given. After identifying the accounts affected, classify each type of account and decide if the transaction causes each account to increase or decrease. Second, be sure that the accounting equation is in balance.
So dear students, once again, 2 steps in transaction analysis. First step, to answer the question what was received and what was given. And here we should identify each account by title, each specific account by title, and then classify each account by type. So assets, liability, also called as equity. So this is the 3 basic elements based in accordance with the main accounting equation. So, and finally, to determine the direction of the effect, there are 2 possible outcomes: plus or minus, increase or decrease. So, and finally, we should verify that accounting equation is in balance after each business transaction. I suggest to watch one transaction analysis illustrated, and also we do today in current material as well.
To illustrate the transaction analysis process, let's assume that Janine decides to incorporate and operate a consulting business. The business issues 10,000 shares of common stock with a par value of $1 per share in exchange for $15,000 cash, and land worth $25,000. So the shares are issued at a market value of $4 per share, which is computed by dividing the sum of the amounts received, $40,000, or the cash of $15,000 plus the land valued at $25,000, by the 10,000 shares issued. Step 1. The business receives cash and land and gives shares of common stock in return. Cash, an asset account, increases by $15,000. Land, another asset account, increases by $25,000. When a corporation issues common stock, the amount received, which totals $40,000, or cash of $15,000 plus land of $25,000 in this transaction, affects two separate stockholders' equity accounts. The common stock account increases by $10,000, which is the product of the 10,000 shares issued times the $1 par value per share. The additional paid-in capital or contributed capital in excess of par account increases by $30,000, which is the product of the 10,000 shares issued times the $3 excess over par value per share. Step 2. The recording of this transaction keeps the accounting equation in balance. Total assets equal $40,000 and total liabilities and stockholders' equity also equal $40,000.
So, dear students, very good demonstration how to apply this transaction analysis for a recording process of every business transaction. So, and now let's repeat once again, what does it mean debit and credit? So these are the main words in accounting language.
Our original approach to transaction analysis, illustrated here by just showing a cash column, included using increases, represented by plus signs, and decreases, represented by minus signs, to show how a transaction affected an account. Let's take a look at how accountants actually record increases and decreases in the company's books. Luca Pacioli, a mathematician and accountant, published a textbook, Summa de Arithmetica, which describes the system of double-entry bookkeeping that we still use today. And since he spoke Latin, he used the Latin word deberere, meaning to owe, to refer to the left side where the payments owed to the business were recorded. This was abbreviated as DR and was translated into the word debit. The Latin word credere, meaning belief or trust, was used to refer to the right side where the payments owed by the business on good faith were recorded. This was abbreviated as CR and was translated into the word credit. Let's go back to our original approach to recording transactions. We recorded all increases and decreases to an account in a single column. Let's split the cash account column into two. The left column is the debit column and the right column is the credit column. Remember what Luca Pacioli decided. For assets, such as cash or accounts receivable, increases are recorded with debits and decreases are recorded with credits. Liabilities and stockholders' equity are on the opposite side of the accounting equation. So to keep things in balance, the rules for debits and credits are the opposite. For liabilities, such as accounts payable, increases are recorded with credits and decreases are recorded with debits. Stockholders' equity accounts follow the same rules as liabilities. Increases to the common stock and additional paid-in capital T accounts, when owners made investments, are recorded with credits. The increase to the retained earnings account, when net income is reflected, is also recorded with a credit. A decrease to the retained earnings account, when dividends are declared, is recorded with a debit. Take the time now to study this summary of the basic transaction analysis model, which is also set forth in your textbook, and refer to it often while you are recording transactions.
So, dear students, I would like to add to this short video that Luca Pacioli developed this system in 15th century. Now you understand how old and how stable is accounting theory and some basic rules which were developed in 15th century are still exist nowadays, and we apply the system which was originally developed so many centuries ago. Once again, debit plus credit minus for assets and debit minus credit plus for liabilities and stockholders' equity. Well, so now let's start the current material I hope now we are already engaged in accounting principles, accounting process, terminology, and other basic issues. And let's start with the definition of operating cycle. I hope today you will understand what is the relationships between current operating cycle and current accounting period.
If a company is to stay in business, cash must be generated from operations, that is, from the activities for which the business was established, rather than from borrowing money or selling long-lived assets. Companies acquire inventory and the services of employees and then sell inventory or services to customers. The operating or cash-to-cash cycle begins when a company receives goods to sell, pays for them, and sells to customers. It ends when customers pay cash to the company. The length of time for completion of the operating cycle depends on the nature of the business. Shortening the operating cycle by creating incentives that encourage customers to buy sooner and/or pay faster improves a company's cash flows. The operating cycle repeats continuously until the company ceases its operations. Reports that cover the entire life of a company are not useful. More timely information is required for decision making. As a result, companies prepare periodic reports by making use of the time period assumption, which assumes that the long life of a company can be divided into specific time periods, such as a month, a quarter, or a year.
So as you see, there is the direct relationship between operating cycle and time period assumption. Of course, we understand that in every business, the length of operating cycle is different. And in order to make information comparable, we should divide the accounting period of every business into specific periods, and these periods are always measured as month, as quarter, or as the whole year. And this is what we call time period assumption. And after that, we compare the activities during this period and develop managerial decisions based on this information. This is what we call operating cycle. First of all, this is the purchases of goods and services to resale or some raw materials in order to start production cycle, then to pay to suppliers, then to sell finished goods or other inventory or services to the customers, get payment from the customers, and start this operating cycle from the very beginning. This is why we call cycle, because we always repeat the same activities in the business. Now let's repeat this content of the income statement and the basic elements of the income statement once again.
Now, let's take a look at a simplified version of an income statement of a company that operates fast food restaurants. This format is known as multiple step. You can tell if a company uses the multiple step format if it has multiple subtotals, such as operating income, income from operations, and income before income taxes. Revenues are defined as increases in assets or settlements of liabilities from the major or central ongoing operations of the business. Operating revenues result from the sale of goods or the rendering of services as the central focus of the business. Expenses are outflows or the using up of assets or increases in liabilities from ongoing operations incurred to generate revenues during the period. Not all cash expenditures are expenses. Only those that generate revenues are called expenses. Gains result when assets other than investments are sold or disposed of for more than their undepreciated cost. Losses result if they are sold or disposed of for less than the undepreciated cost. Note that selling short or long-term investments above or below cost also results in gains or losses, but these are not reported in the operating expenses section of the multiple step income statement. Instead, they're reported in other items discussed below. Operating revenues less operating expenses equals operating income, also called income from operations, which is a measure of the profit from central ongoing operations. Not all activities affecting net income are central to ongoing operations. Any revenues, expenses, gains, or losses that result from these other activities are not included as part of operating income. Instead, they are categorized as other items. Typically, these include interest revenue or investment revenue, investment income, or dividend revenue, interest expense and losses, gains on sale of investments. Operating income, also called income from operations, plus or minus other items, equal income before income taxes, also referred to as pre-tax income. Income tax expense, also called provision for income taxes, is calculated as a percentage of pre-tax income, determined by applying the tax rates of the federal, state, local, and foreign taxing authorities. Income before income taxes minus income tax expense equals net income. Corporations are required to disclose earnings per share, EPS, on the income statement or in the notes to the financial statements. This ratio is widely used in evaluating the operating performance and profitability of a company. It is calculated as follows. EPS equals net income divided by average number of shares of stock outstanding.
So, dear students, very comprehensive and a lot of new information. First of all, we should understand that classified income statement contains different types of income. First of all, operating income or income from operations, income before income taxes, and net income. And also it could be some gross profit, and we calculate these type of income as well in the income statement. So classified income statement, different types of income. On the other side, income statement contains two main parts: central part or operating activities, and some peripheral activities, which we call as other income or expenses. Normally, we include in this part all financial costs concerning with investments or directing the finance for the company. And also we understand that when we prepare income statement, we should provide about net income, but for corporations in some countries, there is a requirement to include the only one financial ratio, and the title of this ratio is earnings per share. Here I see the formula how to calculate earnings per share, net income divided by average number of shares of stock outstanding. But this is not compulsory for all business. Sometimes companies can exclude this information directly from the income statement and put into the notes. Now, let's start with the basic principle of accounting, accrual accounting, and we just discuss what is the difference between accrual basis and cash basis.
Many small businesses, including local retailers and service providers, use cash basis accounting. When the cash basis is used, revenues are recorded when cash is received from customers, and expenses are recorded when cash is paid to vendors or suppliers. Let's assume Deanna's Event Planners Incorporated opened for business on December 1st. During the month, the company planned an event and received $3,200 in cash from the customer. During the same month, the company paid $2,500 for legal advice received during the month, $500 to purchase supplies that were used during the month, and $1,200 to employees who worked during the month. The company produced a negative net operating cash flow of $1,000. This net operating cash flow information, which is reported when the cash basis is used, is often an adequate measure of net income when the owner of the business is involved in its daily operations, and where no external reporting is required. In this example, Deanna is aware about her company's daily operations. However, it is not appropriate when a company is required to report to external users, since it does not provide an adequate measure of the company's performance and, in fact, can be subjected to manipulation. As a result, the cash basis is not permitted when generally accepted accounting principles are used to generate financial statements. We will consider a case that illustrates the problem with cash basis. Let's assume that Deanna realizes on December 26 that she will need a loan from her bank to fund the company's operations for the first few months until the business becomes more successful. Deanna knows that it will be hard, if not impossible, to obtain that loan, given the company's weak performance during the first month. So, when she meets a new customer that day, she has the customer sign a contract, valued at $5,000, for event planning services that will be delivered, or in other words, performed during February. The contract requires payment upfront, and the customer gives her a check that day. Since she uses the cash basis, Deanna takes the income statement that reports $4,000 of net operating cash flows to the bank. Deanna knows that the business provided only $3,200 of event planning services during the month. However, unless the bank loan officer understands the cash basis, he or she may well believe that the business was profitable in its first month of operations, especially if Deanna uses the words net income in the income statement, and use that information in the decision to grant the loan. If the bank loan officer understands different accounting concepts, he will ask Deanna to prepare an income statement using the accrual basis of accounting, which is required by generally accepted accounting principles. The accrual basis requires that revenues be recognized, or in other words, recorded, when they are earned, and expenses when they are incurred to generate revenues. Using the accrual basis, Deanna's business would report a net loss of $1,000. That income statement would report revenues using the revenue recognition principle and report expenses using the expense recognition principle. We'll take a closer look at these principles in a moment.
So this was a very important moment, and let me repeat once again. Then when we calculate a financial result, it could be two possible outcomes, profit or loss. Of course, it could be zero, but we just consider the most common one. So it's a key question how to measure revenues and expenses. And there are two main approaches. The first approach, and we call this approach as a cash basis of accounting, we consider that revenues are always equal as a cash inflow and expenses as cash outflow. And we call the system as a cash basis of accounting. But this basis does not provide the fair view of the business itself, because business is not only the cash inflow and outflow. This is the many different relationships between partners, between companies, and also some international organizations and state authorized bodies. And also it's important to understand, and when we analyze the financial result, we also should consider these relationships. For these purposes, we should apply the accrual basis of accounting. What is the main idea of accrual basis of accounting? To consider revenues when earned and expense when incurred. In the next videos, we learn in detail what does it mean revenues when earned and expenses when incurred. But these accrual basis are the only one which is permitted under national and international accounting standards for preparing income statement. But on the other side, we cannot ignore the cash inflows and outflows. This is why we have one special statement with the title cash flow statement, in order to provide information based on cash basis. So we can say that both systems are really important, but for the preparing income statement, we should apply accrual basis of accounting. But on the other side, in order to provide information about cash inflows and outflows, we should develop another statement, and the title of the statement is cash flow statement. In our basic course, we don't have the topic for detailed analysis of cash flow statement. This is the subject for intermediate course, and if you continue your specialization in finance, of course, we'll learn in detail what is the structure and how to prepare the statement. In this basic course, we should understand the classifications of different business transactions for main activities: operating, financing, and investing activities. But once again, I hope you noticed from this video that when we calculate financial result financial result for this company. We calculated different net loss or net income, and of course it depends on the basis for computations. So let's discuss in detail how to recognize revenue and expense under accrual concept of accounting.
The revenue recognition principle specifies both the timing and amount of revenue to be recognized during an accounting period. It requires that a company recognize revenue when the company transfers promised goods or services to customers in the amount it expects to be entitled to receive. It's easy to recognize or record revenue when the customer pays as the goods or services are delivered. The decision to record revenue seems more complicated when customers pay before or after the goods or services are delivered. You simply need to remember that revenue is earned when the business delivers goods or services. Let's return to Deanna's Event Planners Incorporated and consider some of its transactions with customers. First, let's consider a situation in which cash is received before the goods or services are delivered. Recall that Deanna met a new customer in mid-December and had the customer sign a contract for $5,000 for event planning services that will be performed during February. Since Deanna's company has not yet delivered any services, it records no revenue. Instead, it creates a liability account. In this situation, unearned revenue, representing the amount of event planning services owed to the customer. Later, when the services are delivered, the revenue will be recorded and the liability account will be decreased, since the services will no longer be owed. Next, let's consider a situation in which cash is received when the goods or services are delivered. Assume that Deanna's company delivers event planning services for other customers during February and receives cash payments totaling $10,000. Since Deanna's company has delivered the services, it records the revenue. Finally, let's consider a situation in which cash is received after the goods or services are delivered. Assume that Deanna's company delivers event planning services for another customer at the end of February and sends an invoice for $3,500 to the customer. Since Deanna's company has delivered the services, it records the revenue. It also creates an asset. In this situation, accounts receivable, representing the amount owed by the customer. Later, on receipt of cash from the customer, the cash account will be increased and the accounts receivable account will be decreased.
So let me repeat once again the logic of these revenue recognition principle. First of all, we understand that for revenue recognition, we need the fact of delivery of goods or providing services. So the fact of activity, delivery of goods or providing the service. But also we should we should find relationships with this fact of delivery or providing services with the cash payments. And cash may be received before the fact of delivery, in a moment, and after. So we have three possible outcomes. And for each of these type of outcome, we should make the following records. If we get a payment, a cash before goods, services are delivered, on the first step, we should recognize unearned revenue, and then in a moment of delivery to transfer unearned revenue into the current existing revenue. If the cash received in a moment of delivery, then we should directly recognize increase in cash and increase in revenue, the most simplest situation. And in a case when the cash payment received after goods or services are delivered, in this case, initially we should recognize a debt of our customers, and we call this debt as accounts receivable in correspondence with the revenue. And after that, when cash is received, to increase cash and to decrease accounts receivable. This third situation is the most common approach in market competitive economy, when we first of all should provide goods or services and then to get payment from the customer. This is a special marketing tool to attract customers, first of all to provide service and after that ask for payment. This is why in the practice of companies, this third situation is the most common one. But anyway, we should understand how to treat these activities as well. For example, for retail business, situation number 2 is the most common way of communicating. You go to this supermarket and you purchase something, beverage or any kind of food, and you pay immediately. And in the moment of delivery, company gets payment from you. So this is how we understand every business. Well, this is about our revenue recognition principle. Once again, the moment of delivery and 3 possible outcomes for cash payment: before, in a moment, and after. So let's see how we should match expenses. Expense recognition principle.
The expense recognition principle, or matching principle, requires that costs incurred to generate revenues be recognized or recorded in the same period. In other words, we are trying to match costs or expenses with benefits or revenues. What do we mean when we say an expense is incurred? In an accounting context, think of it as meaning that the company has used up goods or services obtained from outside vendors. It's easy to recognize or record an expense when the customer pays in the same period as the expense is incurred to generate revenue. The decision to record an expense seems more complicated when customers pay before or after the goods or services are used. You simply need to remember that expense is incurred when the business has used goods or services to help generate revenues. Let's return to Deanna's Event Planners Incorporated and consider some of the costs that it incurs to generate revenues. First, let's consider a situation in which cash is paid before the goods or services are used. Recall that the company began operations on December 1st. During December, the company purchased and used supplies. Let's assume that Deanna's company purchased $300 of office supplies on January 2nd. Since Deanna's company has not used any goods or services at that point, it records no expense. Instead, it creates an asset account, in this situation, supplies, representing the amount of future benefit that exists. Even though supplies may be used on a daily basis, most companies do not bother to decrease the supplies account each time supplies are used. Instead, at the end of the month, the company will count the supplies on hand and determine the cost of those supplies. They will then compare the existing balance in the supplies account with the amount on hand to determine the amount that was used during the period. The expense will be recorded, and the asset account will be decreased because those supplies are no longer on hand. Next, let's consider a situation in which cash is paid when the goods or services are used. Assume that the company pays $125 cash for the repair of its copier. An expense has been incurred because the related goods or services, in this situation, the repair services that were delivered to the company, were used to generate revenues during the accounting period. As a result, the company records the expense. Finally, let's consider a situation in which cash is received after the goods or services are used. Many costs are paid after the goods or services have been received and used. Examples include utilities used in the current period but not yet paid for, interest owed on borrowed funds at the end of an accounting period, and wages owed but not paid for work done in the current period. Finally, let's assume that Deanna's company has not yet paid its employees the $300 owed for work performed during the last week of the accounting period. They will be paid the following Monday. An expense has been incurred because the related goods or services, in this situation, the services delivered to the company by its employees, were used to generate revenues during the accounting period. Since Deanna's company has used the services, it records the expense. It also creates a liability, wages payable, representing the amount owed to its employees. Later, when the company pays its employees for this work, the cash account will be decreased and the liability account will be decreased.
Okay, so dear students, as for the expenses, the main word what we use here is incurrence. Incurred expenses should be incurred. So what does it mean incurred? To spend, to consume some portion of assets or other other benefits in order to generate revenue, So in other words, we always call these expense recognition principle as matching principle, just to match revenues and expenses to the same period. So, and also there are three possible outcomes for cash outflow: cash payment before goods or services are used, in a moment, and after. And of course, there are three ways of treatment in accounting for each particular case. If we take cash payment before goods and services are used, of course, we should recognize the decrease in cash and increase the special types of assets. It depends on what is the content of these transaction. It could be suppliers, equipment, or some other prepayments necessary for the business. And after that, when we consume, when we use these kind of asset in the business, we should write off from the balance sheet and to recognize as a expense account in the income statement. For example, if we have the case of inventory, when we deliver this inventory to the customers, we should recognize the cost of goods sold in the income statement and to write off inventory from the balance sheet. If there is a case when the cash payment is in the same time as goods and services are used, then we simply recognize increase in the type of expenses and in correspondence with the cash outflow. And finally, the most common situation when cash is paid after the goods and services have been used. And in this situation, first of all, we should recognize the expense. Let's take this example. Let's take this situation for the about employees expense. We should recognize the wages expense on debit, and also we should recognize in the same time a liability to make a payment in the future. This is why expenses are always corresponded with the payables. Wages expense, wages payable. Tax expense, taxes payable. And this is why we always recognize liabilities as an official obligation to make a payment in the future. And later, when cash is paid, of course, we should recognize cash decrease on credit and liability decrease by debit. Let's discuss expanded transaction analysis model concerning income and revenue recognition.
You should be familiar with the transaction analysis model we use to determine how investing and financing activities that affect assets, liabilities, and contributed capital are recorded in the accounting system. Now, we will expand that model to include operating activities. The complete transaction analysis model includes revenues and expenses. Recall that the retained earnings account is the accumulation of all past revenues and expenses, minus any income distributed to stockholders as dividends, that is, earnings not retained in the business. Revenues and gains increase stockholders' equity through the account retained earnings and therefore have credit balances. That is, to increase a revenue, you credit it, thereby increasing net income and retained earnings. Expenses and losses decrease stockholders' equity through the account retained earnings and therefore have debit balances. That is, to increase an expense, you debit it, thereby decreasing net income and retained earnings.
So this is the expanded model, which is based on the traditional math approach. So let's discuss retained earnings in details. What does it mean, retained earnings? Retained earnings, these are the accumulated net income for several accounting periods. What does it mean, net income? Net income is the difference between revenues and expenses. And we understand that revenue has a positive sign, so revenue is positive, and expenses we should subtract. So we have minus sign in front. So, and when we consider revenues, also we should apply the same formula in general for the right part of the main accounting equation, debit minus credit plus. Here we have debit minus credit plus. But as for the expenses, we have minus sign in front. And this is why minus to minus give you plus, and minus to plus give you minus. This is why for expenses, we should apply the opposite approach, plus for debit and minus for credit. So this is what we should understand. And in order to recognize increase in expenses, we should debit all expenses. But as for the revenues, we should credit all revenues. And now you can see that we always stay in balance because of this mathematician approach. Let's see transaction with customers in order to understand the application of transaction analysis.
Let's apply the expanded transaction analysis model to transactions with customers. Recall that Deanna met a new customer in mid-December and had the customer sign a contract worth $5,000 for event planning services that will be performed during February. Let's start by asking whether or not a revenue was earned by delivering goods or services, or an expense was incurred to generate revenue in the current period. Since the answer is no, let's ask what was received and given. The company received cash and gave a promise to deliver services in the future. With this in mind, the entry to record this transaction includes a debit to cash to increase that asset account, and a credit to unearned revenue to increase that liability account. Now, let's assume that Deanna's company delivers event planning services for other customers during February and receives cash payments totaling $10,000. Again, let's start by asking whether or not a revenue was earned by delivering goods or services, or an expense was incurred to generate revenue in the current period. This time, the answer is yes, a revenue was earned. With this in mind, the entry to record this transaction includes a debit to cash to increase that asset account, and a credit to event planning revenue to increase that revenue account. Now, let's assume that Deanna delivers event planning services for another customer at the end of February and sends an invoice of $3,500. Again, let's start by asking whether or not a revenue was earned by delivering goods or services, or an expense was incurred to generate revenue in the current period. This time the answer is yes, a revenue was earned. With this in mind, the entry to record this transaction includes a debit to accounts receivable to increase that asset account, and a credit to event planning revenue to increase that revenue account. Finally, let's assume that Deanna's business receives $3,500 cash from customers paying on their accounts. Again, let's start by asking whether or not a revenue was earned by delivering goods or services, or an expense was incurred to generate revenue in the current period. Since the answer is no, let's ask what was received and given. The company received cash and gave a reduction in the amount due from customers. With this in mind, the entry to record this transaction includes a debit to cash to increase that asset account, and a credit to accounts receivable to decrease that asset account.
So let's repeat once again the process of transaction analysis for revenue and expense recognition. Also, we have two steps as in traditional transaction analysis, but there is a small specification for the step number one. First of all, we should answer the questions concerning revenue or expense. Was a revenue earned by delivering goods or services? And was an expense incurred to generate a revenue in the current period? There are two main questions concerning revenue or expense recognition. So if these positive answer for the first question and the revenue was earned, so the credit, we should credit the revenue account and debit the appropriate account for what was received. It could be cash or a promise to make a payment in the future. In this case, we recognize accounts receivable. The second question about incurrence of expense. So if the answer is positive, if we have the fact of incurrence of expense, then we should debit the expense account. Look, we should credit the revenue account and debit the expense account, and credit the appropriate account for what was given. So if it's a cash, we should recognize cash. If it's an obligation to make a payment in the future, we should recognize the type of payables. So this is the first part in this first step. But if the answer to these first two questions, if the answers for these two first questions are negative, so we have no revenue or expense incurred, then we should continue with the normal transaction analysis and answer the question what was received and what was given, and then identify the accounts affected, then classify them by type of account, and determine the direction of the effect. So this is again the transaction analysis, three components: accounts, types of accounts, and direction of the effect. And finally, of course, we should verify that the accounting equation is in balance. Please remember that after absolutely each transaction, assets are always equal to liabilities plus stockholders' equity plus stockholders' equity. So on this slide, we have the case of the common situation that we have the delivery of goods and services before cash payment. This is why we initially recognize revenue in correspondence with accounts receivable, and after, on receipt of cash, we should recognize cash, increase cash, and decrease accounts receivable. So this is the formula for competitive market economy. First, a revenue recognition with a promise to make a payment on behalf of the customer, and after the payment of the customer, and we regulate these relationships when decrease accounts receivable and increase cash. And increase cash. So this is transactions with customers. So the main formula and the transaction analysis. Well, let's discuss transaction relating to operating costs. Again, this is the expense recognition in order to calculate financial result for the period.
Let's return to Deanna's Event Planners Incorporated and consider some of the costs that it incurs to generate revenues. We'll apply the expanded transaction analysis model to transactions involving those operating costs. Let's assume that Deanna's company purchases $300 worth of office supplies on January 2nd. Let's start by asking whether a revenue was earned by delivering goods and services, or an expense was incurred to generate revenue in the current period. Since the answer is no, let's ask what was received and given. The company received supplies which have future benefit and gave cash. With this in mind, the entry to record this transaction includes a debit to supplies to increase that asset account, and a credit to cash to decrease that asset account. Now, let's assume that the company pays $125 for the repair of its copier. Again, let's start by asking whether or not a revenue was earned by delivering goods or services, or an expense was incurred to generate revenue in the current period. This time the answer is yes, an expense was incurred. With this in mind, the entry to record this transaction includes a debit to repairs expense to increase that expense account, and a credit to cash to decrease that asset account. Finally, let's assume that Deanna's company has not yet paid its employees the $300 owed for work performed during the last week of the accounting period. They will be paid the following Monday. Again, let's start by asking whether or not a revenue was earned by delivering goods or services, or an expense was incurred to generate revenue in the current period. This time, the answer is yes, an expense was incurred. With this in mind, the entry to record this transaction includes a debit to wages expense to increase that expense account, and a credit to wages payable to increase that liability account. Finally, let's assume that Deanna's business pays the $300 owed to its employees on the following Monday. Again, let's start by asking whether or not a revenue was earned by delivering goods or services, or an expense was incurred to generate revenue in the current period. Since the answer is no, let's ask what was received and given. The company received a reduction in the amount due to employees and gave cash. With this in mind, the entry to record this transaction includes a debit to wages payable to decrease that liability account, and a credit to cash to decrease that asset account.
Okay, so dear students, in this video, there are several types of business transactions, including expense recognition. Let's consider once again salaries expenses, because this is one of the most important expenses in every company, and all companies must pay salaries, to the employees. And of course, it's a question how to make records and how to treat salaries or wages expenses. First of all, if we apply the traditional transaction analysis, we should understand that we have the case of revenue or expense. In the case of wage, of course, it's an expense. And normally, when we recognize wages, expenses initially, we announce these expenses in correspondence with the liability to make a payment, and after we pay these salaries to the customers, because the process of recognition salaries expense includes the income tax computations and other taxes, other social taxes as well. This is why, first of all, we should recognize an expense, and after that to pay the net amount, So in this case, we should recognize wages or salaries expense in correspondence with the wages or salaries payable, expenses, of course, on debit, and payables on credit. And after that, on payment of cash, after the recognition of these expenses, we should decrease cash, because this is the cash outflow. And on the debit side, we should decrease an obligation, a liability for employees, and we put wages payable on debit. You see, minus liabilities, minus assets. So this is cash outflow and decrease in liabilities in the same moment, And now let's repeat once again how to treat and how to treat revenues and expenses in order to prepare classified income statement.
After the journal entries of the company's investing, financing, and operating transactions are recorded and posted to the general ledger T accounts, we will prepare a trial balance to ensure that the sum of the accounts with debit balances equals the sum of the accounts with credit balances. This trial balance can also be used to prepare the company's financial statements. Why is the trial balance labeled unadjusted? At this point, we have not yet reviewed the company's accounts to ensure that all revenues earned and all expenses incurred have been recorded. For example, a company might have delivered goods or services to customers on account on the last day of the accounting period, but might not have sent the invoice, which means the related revenue would not yet be recorded. We will discuss the end-of-period adjustment process that is required to record any other revenues and expenses in the next chapter. The unadjusted trial balance can now be used to prepare an income statement. If operating activities are distinguished from peripheral activities, as seen in this example, we would refer to the income statement as being classified. The results of operating activities are highlighted by the subtotal income from operations, and other revenues and expenses are listed below that subtotal. At this point, any financial statements prepared from the unadjusted trial balance should be labeled as unadjusted, and those financial statements should not be provided to external users.
So, dear students, in this video, and this part of new material includes a very important moment concerning adjustments. In order to prepare income statement for external users, first of all, we should match revenues and expenses for the same accounting period. And we call this matching process as the list of adjustments or matching revenues or expenses to adjust revenues for the period and to adjust expenses for the period. So once we open the trial balance and before any kind of adjustments, we have unadjusted trial balance. And about adjustments, we learn in the next topic, topic 4, how to complete the accounting cycle and how to provide financial statements for external users. But right now, what is important to understand that to prepare income statement for the period, we should provide some additional accounting procedures. Once again, if we take the income statement and prepare income statement as an adjusted income statement, we also should classify all activities into main operating activities and some additional or peripheral activities. This is why income statement includes 2 main components. You see, the first one, the main one, and the result of the operating activities we calculate as income from operations or operating income. And this is very important information in order to analyze business efficiency as the main focus of every business. So this is income from operation, important amount. But also we should add any other activities if these activities generate revenue or expense. It is always the result of some investment activities, or it could be some results from financing activities. So interest revenue or interest expense or other income and other expense, including profit or gain or loss on investments. Then we calculate income before income taxes or pre-tax income. And please remember that income tax expense always has this separate position. We cannot include income tax expense into the operating activities. So normally the list of operating expenses does not include income tax expense. So this is the special place for income tax expense in order to calculate net income before income taxes minus income tax expense, we get net income. So once again, please remember that unadjusted financial statements should not be provided for external users. This is why this is the internal document for some understanding of the situation in the company. And also please remember that income statement includes 2 main parts, operating activities and peripheral activities. And finally, I would like to mention cash flows from operating activities. This is what I told you. Then concerning cash flow statement, we do not learn in detail the structure of the statement, how to prepare, but we should classify properly all business activities into 3 main categories: operating activities, financing activities, and investing activities. So in the previous topic, we discussed financing and investing activities. Let's discuss operating activities in the cash flows.
Cash flows from operating activities include cash from operating sources, primarily customers, and cash to suppliers and others involved in operations. The accounts most associated with operating activities are current assets, such as accounts receivable, inventories, and prepaid expenses, and current liabilities, such as accounts payable, wages payable, and unearned revenues. Investing activities include buying and selling non-current assets and investments. Financing activities include borrowing and repaying debt, including short-term bank loans, issuing and repurchasing stock, and paying dividends. If you see cash in a transaction, it will be reflected on the statement of cash flows.
So once again, when we classify cash flows into operating and investing and financing investing activities, we can find some relationships with the balance sheet format. And normally operating activities, this is activities with the current assets and current liabilities. So we just include into the current assets, first of all, inventories, prepaid expenses. But also I would like to mention especially the investments. Investments could be long-term or short-term, current or non-current, but it does not matter for classification. We always treat investments as a part of investing activity. So there is one exception from the current asset list concerning investments. If we have investments in this list, we should exclude. The same approach for the current liabilities. When we treat current liabilities, we also understand that this is the part of operating activities, except of bank loans. If the company gets a short-term loan, a loan for the current period, we cannot consider this as operating activity. It is always financing activity, even if this activity is in a short period of time. So please remember that operating activities mainly concerning current assets and current liabilities, excluding investments and loans. As for investing activities, it is always long-term or non-current assets, so assets for several accounting period. This is why we call investments. Investment, this is the financing the business in the long term for several accounting periods. And as for the financing activities, this is activities in the liability side, long-term liabilities, owner's equity, of course. And if we have short-term loans, we also should include into the part of financing activities. So this is about financing activities. So dear students, for you, it's important on this level, on basic level, to classify properly activities into three main sections: operating, investing, and financing. But the goals of our course don't include the task to prepare cash flow statement. What we should understand: how to prepare balance sheet, income statement, and of course a statement of changes in stockholders' equity, because without this statement we cannot prepare balance sheet. So we have 5 minutes left, and I would like to show you maybe some additional training video in order to explain how to treat exercises and tasks for the seminar number 3. Let me just find these videos. Just a second. It's too long. Yes, okay.
In this video, we will work through a new exercise aimed at analyzing transactions to determine if a revenue or an expense is to be recognized in a given period, and to indicate the account title and the amount to be recognized. We will also explain the reason for not recognizing a revenue or an expense in that period. We are given the details of 8 transactions that took place in July. In the first transaction, Apple Incorporated received an order from Best Buy for a large quantity of Apple products with a sale price of $5,250,000. However, the delivery of products was made only in August. As per the revenue recognition principle, a company must recognize revenue at the point in time when goods or services for the value expected to be received have been transferred. In this case, the delivery of products of the entire sale value of $5,250,000 takes place in August. Thus, Apple will not recognize any revenue in July. The revenue will be recognized when the delivery of products takes place in August. In the next transaction, customers paid $132,000 on account to Staples Incorporated in July for items delivered in June. Recall that as per the revenue recognition principle, a company must recognize revenue at the point in time when goods or services for the value expected to be received have been transferred. In this case, Staples delivered the items in June, and so the revenue must be recognized in June. Therefore, Staples must not recognize the receipt of $132,000 in July. In the third transaction, Time Incorporated, publisher of the popular weekly People magazine, received $93,600,000 in annual subscriptions for 52 weekly magazines at the beginning of July. 4 weeks of magazines were delivered in July. Recall that a company must recognize revenue at the point in time when goods or services for the value expected to be received have been transferred. In this case, Time received $93,600,000 annual subscription for 52 weeks, but delivered only 4 weeks of magazines in July. Therefore, Time will recognize revenue of $7,200,000, which is the subscription revenue for 4 weeks, calculated by multiplying $93,600,000 by 4 and then dividing it by 52. In the next transaction, the University of Chicago received tuition fees of $320 million in July for the upcoming academic year beginning in October. The services will be provided by the university only from October. Therefore, no revenue will be recognized in July. Instead, revenue will be recognized as the semester progresses. In the fifth transaction, Rite Aid Corporation paid $300,000 for insurance for 12 months beginning on July 1. As per the expense recognition principle, expenses incurred to generate revenues must be recorded in the same period to match costs with benefits. As with revenues and cash receipts, expenses are recorded as incurred, regardless of when cash is paid. In this case, Rite Aid Corporation paid $300,000 for insurance on July 1 to cover 12 months beginning on July 1. Insurance expense must be recognized in July for 1 month. The amount of insurance expense will be $25,000, which is calculated by dividing $300,000 by 12. In the next transaction, Cisco Corporation paid its truck drivers $1,500,000 for 2 weeks of work ended on July 7. The 2 weeks of work includes 1 week of work in June and 1 week of work in July. Therefore, Cisco must recognize wages expense only for 1 week of work done in July, which amounts to $750,000, calculated by dividing $1,500,000 by 2. In the seventh transaction, Pizza Aroma purchased and installed a new oven by paying $5,600 in cash on July 31. Although the purchase and installation were done on July 31, the oven was not used in the month of July to generate revenues. Thus, no expense will be recognized in July, as the equipment was not yet used to generate revenue in this month. In the last transaction, Maguire Auto Dealership received its utility bill totaling $930 for usage in July on July 31. However, the bill will be paid in August. Recall, as per the expense recognition principle, expenses incurred to generate revenues must be recorded in the same period to match costs with benefits. As with revenues and cash receipts, expenses are recorded as incurred, regardless of when cash is paid. Therefore, Maguire Auto Dealership will recognize utilities expense for $930 in July.
So, dear students, I hope this short video about treatment of business transactions with revenues and expenses helps you to prepare solutions for the exercise this in the next topic, topic three. Right now, the time of our lecture is over. Let me stop recording and